This is MacroVoices, the free weekly financial podcast targeting professional finance, high net worth individuals, family offices, and other sophisticated investors. MacroVoices is all about the brightest minds in the world of finance and macroeconomics telling it like it is, bullish or bearish, no holds barred. Now, here are your hosts, Eric Townsend and Patrick Ceresna.
MacroVoices episode 362 was produced on February 9th, 2023. I'm Eric Townsend. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Eurodollar University founder Jeff Snider returns as this week's feature interview guest. As usual, Jeff brought us another great chart deck you won't want to miss. We'll examine whether the Fed has really achieved the soft landing they've been crediting themselves for. We'll talk about credit markets, Eurodollar curves, recession outlook, and more.
And I'm Patrick Ceresna. Listeners, be sure to stay tuned for our post-game segment after Eric's feature interview with Jeff when Eric, Nick, and I discuss the charts on the S&P 500, NASDAQ, VIX, gold, oil, and more. Now, Eric, before we move on to the feature interview with Jeff, let's cover crude oil, starting with that EIA inventory.
EIA inventory came in with a build of 2.4 million barrels, and this was the second week in a row that there was no drawdown from the Strategic Petroleum Reserve. Cushing, Oklahoma, building 1 million barrels. The big build on the board was gasoline, 5 million barrels, and then distillates, 2.9 million barrels. So the big builds were on the products, but still a pretty good build on crude. Builds across the board. U.S. production up 100,000 barrels to a post-pandemic high of 12.3 million barrels. Tape action. The market had headed down ahead of inventory, apparently anticipating a different number, and then retraced higher and hit a new high of the day before the close. Now, the last few weeks, we've had a series of 7 big builds, and of course, builds are normally bearish. For the most part, prices have been holding. Last week was the exception, where we actually saw the market move as expected based on the inventory data. This week, we seem to be back to the market pretty much ignoring inventory, holding without any real downside, despite really big product builds and a pretty significant crude oil build.
Well, this week's feature interview guest is Eurodollar University founder Jeff Snider. Now, Eric, why did we get Jeff back on the show this week?
Well, Jeff is a listener favorite, and with the Fed declaring its own success, I wanted to get a second opinion.
Well, Eric's interview with Jeff is coming up as MacroVoices continues right after this message from our sponsor.
If you invest to bring about a world powered by green energy, you should meet Respect Energy, a leading European trader of renewable energy that serves as a one-stop shop for green energy investors in Europe. Respect Energy brings together independent power producers, accredited and institutional investors holding assets in renewables, or undertaking investments in new green energy production, such as wind and solar photovoltaic power plants. More than 600 institutional and accredited investors have already entrusted Respect Energy with the sale of their electricity production, portfolio management, O&M services, EPC, and project development. If you want to invest in green energy in Europe with the help of a trusted partner, contact Respect Energy today and ask for a tailor-made solution. For more information, visit respect.energy.
And now, with this week's special guest, here's your host, Eric Townsend.
Joining me now is Eurodollar guru and Eurodollar University founder, Jeff Snider. For anyone who's not familiar with Jeff's work, he is known for terrific graphs, charts, and slide decks, and this week is no exception. So be sure to download Jeff's slide deck to accompany this interview. Registered users will find the link in your Research Roundup email. If you're not yet registered, just go to our homepage, macrovoices.com. Click the red button above Jeff's picture that says Looking for the Downloads. Jeff, it's great to get you back on the show. Before we dive into the slide deck, I just want to start with kind of the high-level picture because Inflation is on everybody's mind. We've had a number of people that have expressed this transitory view that basically inflation was entirely about supply chains and pandemic ending. It was a flash in the pan. It's all going away. We're headed back down to 2%. There have been some other guests that we had who've said, well, wait a minute, we've got a new inflationary trend. Reshoring of critical industries is going to be inflationary. There are other secular inflation causes that are going to allow us to come off of those high numbers after the pandemic, but we're not going back down to 2%. We're going maybe down to 4% if we're lucky. Then just last week, we had Alex Gorevich said, no, forget about 2%. We're going negative. We're headed into a deeply deflationary event. Now, last time we had you on, you said, well, it's a little more nuanced than all of that. The price increases are probably likely to continue, but it's not monetary inflation that's causing them. So this is all kind of a big jumble in my mind. Before we dive into the slide deck, just give me the big picture rundown. How should we be thinking about inflation now in these post-pandemic times?
Yeah, Eric, well, first of all, thanks for having me back. I always look forward to coming on MacroVoices and chatting with you because we get to talk about all this interesting stuff because we live in such interesting times. And I think that is probably the big question on everybody's mind. We went through this consumer price shock that lasted probably longer than most people were expecting, myself included. And then it's now maybe we're seeing some progress in it, but what really comes next? Is it just a transitory disinflationary period? Are we going to see long run trends rise well into the future? So there's, I think, enormous questions and uncertainty, I think, is certainly in the public mind about what really comes next now that CPIs are starting to come down a little bit. I liked how you said that my view is usually more nuanced because usually over the long run, the way consumer prices behave can be very different from one time to the next. But as you already pointed out, from my view of the monetary perspective, that kind of precludes long-run secular inflation because we still don't see the type of money excess that you would need or require in order to lead into something like the 1970s all over again. Because really, that's all inflation is. Genuine inflation is nothing more than excessive currency creation, chasing too few goods. Whereas I believe, I fall into the camp where you already referenced so many other people who think about consumer prices over the last couple of years as being transitory because they were due to simple economics where demand shifted in part by government intervention, went further than supply could service. Therefore, again, simple economics, prices had to adjust. But in adjusting to higher prices, it creates this discontinuity in the overall macro global economy, which has to be worked out one way or the other. Either the economy has to come roaring back at some point to allow for consumers and businesses to pay for these higher, especially basic necessity costs, or those higher prices will be the cure for the higher prices because eventually the economy will have to fall off because of too much activity being redistributed to the least productive parts of the system. And I think that's what we're seeing right now. We can get into the slide deck for it, but big picture, general terms, I don't see anything that looks like the 1970s. In fact, this is a question going back to the 1970s that officials and economists had wrestled with at the time. And I always use this quote from former Federal Reserve Chairman Arthur Burns in August of 1971, that quite auspicious month back then, where he recognized that, okay, we had consumer price increases, we had genuine inflation up until the recession of 69-70, and then everybody expected that the recession would tamp down on those consumer price pressures, and after we got through the 69-70 recession, that would be the end of the whole affair. But that's not what happened. And so in August 1971, Burns testified to Congress. And he said, a year or two ago, it was generally expected that extensive slack and resource use, such as we've been experiencing, would lead to significant moderation in the inflationary spiral. This has not happened, either here or abroad. The rules of economics are not working in quite the way they used to. Except he was wrong. The rules of economics were working fine. What he was missing, I think what a lot of people are missing today, is the underlying monetary issue. Burns and the Federal Reserve back then, they had no idea what was going on in the Eurodollar system. They really didn't have much idea what was going on in the banking system either, except that the banks were making tons of new loans all the time. And that was what was creating the next wave of what would become the great inflation. But without that monetary expansion in 2022 into 2023, we should expect, as Burns was in 71, that if we do have a recession this year, and I believe we will, that should be enough to reduce the supply shock pressures and bring consumer prices back down. But the question is, what does that mean? Does it mean that consumer prices or the CPI goes back to 2%, as you alluded to? Or is there a little bit more of a more nuance there where consumer prices might fall a little bit as we go through maybe a deep recession and then come back up to more of a lower and disinflationary level in between? I think that's the major question that we really should be wrestling with right now.
Well, let's go ahead and dive into the slide deck, which is titled The Landing. Now, just the title makes me curious because a lot of people really thought by now, once we get past the first of the year, we're going to be in deep recession. A lot of people are starting to say maybe the Fed has pulled off a soft landing. I'm skeptical of that view, but it doesn't seem like we're in the deep recession, the deep, painful recession that a lot of people thought we'd be in by now. So have we achieved some kind of landing, soft or otherwise?
I don't think we can say for sure. I think, our suspicions, I think, are well grounded for a lot of reasons, which we'll get into here. But the question of whether or not we're in a soft landing or hard landing is, as usual, it's a difficult one because during these periods where we transition from expansion into contraction, it's not a continuous, smooth, incremental process. It's actually very difficult to tell one from the other because at some point, the economy will look like it's entering a soft landing, but then we'll just keep going into what then becomes a recession. And even the economic and macro data during that period becomes very confusing. One day you'll get an economic account that looks like, oh boy, we are in nasty recession, such as, we saw imports and spending fall in the United States in November and December. Some really ugly data there. But then, of course, last week we got the huge payroll number in the U.S., which then, okay, maybe we did get a soft landing. So during these periods, we don't really have a clear sense, especially in terms of data, which says one or the other. All we really can say for sure is that the economy is slowing down. And what that means is we need some way to guide and to tell us which is which is what we'll get into here. But I think you're right, Eric. A lot of people have gotten the sense that, number one, this disinflationary period is transitory. And the reason is because either the Fed has engineered a soft landing or the global economic system has been resilient enough, despite all these numerous headwinds, to not suffer a major recession. We saw that in Germany, that the German government just recently said, all you people were expecting a nasty recession, we don't see it. In fact, we're forecasting 2023 to be that mythical soft landing where we won't even have contraction in GDP. And I think there's really three parts of what are driving people toward the soft landing viewpoint. One is, again, as I just said, that Europe has avoided the worst case scenario, which was last year that electricity prices were going to go through the roof, which they did, and then continue to go through the roof, would just decimate the German economy, the European economy as a whole. Things might go further wrong in Ukraine, leading to really some bad scenarios. So those didn't happen. At least, the worst case scenarios, because electricity and energy prices tended to fall through the end of last year, which has got a lot of people thinking that, okay, Europe has avoided the worst case, so maybe it'll avoid every bad case. The second thing is the U.S. economy seems to be resilient, as I just referenced before. The payroll report for January was exceptional, though maybe a little bit too exceptional to be believable. But either way, even you look at some of the other jobs data, it's not clearly into major contraction territory, which suggests maybe the economy's hanging in. And the third thing, of course, is that now China is more fully reopening. That'll provide another boost to the economy. So if we go to the third slide here, the first part before we get into any of those other three issues, we have to consider that consumer price pressures are abating, because unless we have falling consumer price increases, so second derivative, not necessarily falling prices, but slowing consumer price increases, it'll be difficult for any economy to weather that type of headwind, which will mean that if consumer prices don't prove to, or this disinflationary trend doesn't prove to be transitory, that will jeopardize the soft landing, because it will mean that whether the US economy or Europe or wherever it happens to be, they'll have to suffer for more consumer price and producer price pressures, which will lead to potentially recession there. So when we look at slide 4 going forward, slide 4, 5, and into slide 6, what you see in the United States is exactly what Jay Powell had said at his press conference in early February, which is that we can now say, I think, for the first time, the disinflationary process has started. And we can see that really in goods prices. And yes, the US CPI has been decelerating. It hasn't been falling. The couple months it's been declining, but there's been a big radical change around July. So last summer, we see, of course, coincident with oil prices, we see consumer price indexes, including the core CPI when you adjust for, even excluding OER, owner's equivalent rent. There's a big change in consumer price behavior around June, which raises the question, I think an important one, what really happened back in June and July that would cause consumer prices to start to decelerate then? And I don't think it was the rate hikes from the Federal Reserve or the ECB or anywhere else in the world, because even proponents of rate hikes would tell you that rate hikes take some time to have that kind of an effect. And what we saw was almost an immediate effect, which to me suggests that something changed inside the actual economy that had nothing to do with the Federal Reserve, which is one reason why we might look at falling consumer price gains or slower consumer price gains with a little more suspect than you would imagine from the soft landing. In other words, what if consumer price increases are declining because the economy actually is, rather than because the Federal Reserve or whatever central bank has engineered a soft landing? And we look around, it's not just the US. We see this shift in behavior in consumer prices pretty much in a lot of places around the world. Slide 7 and slide 8 just present a couple other ones here. Well, on slide 7, we have French Consumer Price Index, which hasn't come off the same way that it has in the US or other places, but still you can see a marked change in the behavior around July. A big one for me is Germany. Though consumer prices continue to accelerate up until October, you can see other places, whether it be producer prices or wholesale prices, where we still see something changed around last summer. And again, slide 9, the quote I mentioned before, the German government looks at falling consumer price indexes or rates of change and looks at that as this is the best possible case, that consumer price pressures are falling, which will lead us into a soft landing. Whereas you look at some of the markets, which is what we really think need to focus on, how are markets looking at all of these macro developments and pricing the probabilities based on those? And if you go to slide 10, look at the German federal securities market, which is the bond market, the German equivalent to US Treasuries. And again, you see some pretty substantial changes going back to last summer. Again, middle of June, we saw the German curve start to flatten out. Rates started to fall a little bit. And then even as the ECB was hiking rates, in particular October, where the German curve radically shifted in a way that we have never seen before. This is unprecedented inversion in Germany, which already raises some alarm bells here. Because as we know, inversion is usually associated with more of the bad types of macroeconomic and financial outcomes than soft landing. Not only that, what's interesting is that the shift in the German curve happened at the same time as what we see in other curves, including US Treasuries and Eurodollar futures, which we'll get to in a minute. But especially the inversion really went nuclear when the US reported its October CPI, which I think most people will remember is that's what kind of kicked off this disinflationary wave throughout the marketplace. Was the idea back with the October CPI that we could really clearly see that consumer price pressures were starting to abate. And rather than see that as a positive, here we see in Germany the same interpretation of consumer price pressures, but for what have to be very, very different reasons. If we go to slide 11 and slide 12, you can really see how the German curve has changed over those couple months, where, again, this is absolutely unprecedented inversion in that marketplace, which, I mean, to me, that can't be a good thing. That's not really a good thing here. When you see curves invert anyway, but to the degree that they have in Germany, when Germany is supposed to be the most boring, uninteresting market that there is. And yet now the curve looks a lot more like U.S. Treasuries or Eurodollar futures than not. To me, that tells me that there's so much hedging demand in that area. It has to be because participants in the marketplace are thinking about not soft landing type of outcomes, but I really need to hedge against some of the worst possible cases, even if we don't see it just yet. But if you look ahead in slide 13 and into 14, and I could have added more data points here, but I think these couple here really make the case. Even though the German government forecasts no recession and has become much more optimistic, the same week they made that forecast, they also reported some pretty terrible economic numbers. You see that both nominal and real retail sales in Germany absolutely collapsed in December, which is consistent with what the market was saying back in October and November by turning into this unprecedented inversion. So the market may have been onto something where the German economy, at the very least, though this isn't just about Germany, German bonds are also connected globally, but at least the German economy seems to have suffered a severe stumble in December. You see the same thing in German trade on slide 14, where you have massive contraction in exports as well as imports into Germany. And what was interesting about this one is that German exports to the US and China, its biggest customers, were down the most. And they were down really substantial numbers just from November. So from the German perspective of Europe avoiding the worst case scenario, the first bullet point of our soft landing fever, I'm not so sure that's the case, because it might be that just now the macro data is starting to pick up on what was a more serious contraction in that economy. And just today, we got some more data, including German industrial production, which was down big also in December too. And factory orders, even though factory orders rebounded in December, that was mostly about aircraft, large scale orders, and underlying that the volatility, factory orders, which were down huge in November, were down again in December. So maybe we jumped the gun a little bit here on saying Europe avoided at least a recession. Maybe it avoided the worst case scenario of an electricity, crisis where people can't heat their homes and that type of really big catastrophe. But that doesn't mean that Europe and Germany have avoided all downside and negative cases.
Let me ask you a question about that, Jeff, because the way I see this, we're kind of in a calm before the storm moment here, or at least that's what I think it is, where we had Europe in an energy crisis moment that has mostly come under control now, and I think it can stay under control as long as economic demand is suppressed. But the thing is, what's different this time is the usual safety buffer mechanisms. If you get a sudden increase and the economy really starts to pick up and industrial activity picks up, what happens is OPEC has plenty of spare capacity. They see the data coming. They start to turn the knobs up and produce more oil. And you've also got the huge global commercial inventory system, which acts as a buffer that you can draw against. Well, we have a situation now where OPEC is out of spare capacity almost completely. Saudi Arabia and United Arab Emirates are the only two countries left that still have some spare capacity, and they don't have a whole lot. Meanwhile, inventory has been drawn down to generationally low levels in both commercial and strategic petroleum reserves. So the buffer mechanisms to absorb an increase in economic activity and increased demand for energy just aren't there. So that sort of sets the stage for there could be another really big energy crisis moment. But at the same time, if we're about to fall into a global recession as an echo of the pandemic, well, that's going to mute demand, and that will delay this moment of reckoning in energy markets that I'm predicting, potentially for a few years. So if you accept that basic premise that we don't really know what's going to happen, and we can keep energy prices under control as long as demand doesn't pick up, but the system is unable to absorb a significant increase in demand because there's just no supply to meet it. How does that affect your analysis?
I agree with you. I think that's really the consideration, but not for this year, but as something down the road. And so the inability, the rigidity of the energy supplies and really other forms of commodities too. I think that's going to plague the recovery after we get through this next year, which likely will be, I think, a recession. And so that will keep a lid on the ability of the economy to rebound from that one. So we'll have even more problems to worry about after we get done with it. But I think what the German curves are telling us, and now the German data, as well as European data, you look at European retail sales, they were horrible too. I think the damage has already been done. I think the damage from the energy crisis last year eroded enough of the European and really the global economy's ability to spend and businesses to hire and all the basic economics that must happen. I think that the damage was already done. And so what we're seeing here now is the delay from that damage finally working its way through out into the open, or at least more open. So going back to what you said about energy and oil, I do think demand will temporarily fall enough to keep prices in energy and other commodities relatively behaved for the time being. Again, I think that then it becomes a bigger issue when we get through the recession, however long this might be, depending on what it ultimately looks like. Will it be short and sharp? Will it be shallow and prolonged? Will it be deep and prolonged? But I think, I agree with you, Eric. On the other side of the recession, there's going to be still these problems where we have to reckon with ridiculous supply constraints, which really shouldn't be an issue, but here we are.
Let's go ahead and get back into your slide deck then. Page 15, you're talking about Jay Powell saying, given his outlook, he doesn't see rate cuts this year. Does that mean he's done hiking? Is this a signal that the hikes are over and it's a question of waiting until it's time for rate cuts?
I don't think Powell knows for sure. Even if he does have an idea, he's certainly not going to tell anybody in the public. But I think the Fed is preparing for reaching its terminal rate. But then they want to make sure that everybody knows, just because they might stop hiking after maybe the next meeting, or maybe they're done already, who knows? It depends on how things develop. He doesn't think that means that rates are going to go down immediately, because in his and the Federal Reserve's and most mainstream base cases, we've reached a soft landing. The Fed has achieved its goal. Consumer prices are starting to round up or round over and roll over and head lower. The economy seems to be resilient, at least in terms of some of the employment numbers, like the unemployment rate in the establishment survey. So as far as the Fed is concerned, if their outlook comes true, and you have to agree with them here, if that outlook is true, there would be no need to cut rates. But the problem with that is when we look at these markets, I already mentioned the German market, which is heavily inverted, unprecedented inversion, which speaks about the future direction of yields going lower. And if you go to slide 16 and the next few slides here in the series, you see that the US dollar markets are all doing the same thing too, including something that Jay Powell pointed to last year. If you remember back in March, the US Treasury yield curve between the 2-year and 10-year, so the 2-10 spread, first inverted last March. And Powell said, no, we don't pay attention to long-term rates because they're affected by supply factors and all this other minutia that means that we can't look at the yield curve. It's all spoiled. Instead, we look at something called the near-term forward spread, which is nothing more than comparing the current 3-month rate with what the market expects the 3-month rate to be 6 quarters ahead, or 18 months. And the near-term forward spread back in March was relatively steep. So he said, we don't see any problems ahead. But fast forward again, we see that October CPI show up in the near-term forward spread, just like it had in Germany. Well, the market looked at that CPI and said consumer price pressures are likely coming down, but likely not for good reasons. And if we take the near-term forward spread rather literally, what it means essentially is the market is expecting 3-month rates to be lower 6 quarters ahead than they are today. And in the course of January, heading toward February, the near-term forward spread collapsed to a level that we haven't seen in it in a very, 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 very long time. It's even worse than it got to be at the worst part in 2006 and 2007. So the market looks at Jay Powell's statement saying, I don't think rates are going to come down. And the market's saying, well, there's a very high probability that, at least according to the near-term forward spread, that 6 quarters ahead from now, rates will be substantially lower than they are today. And if you look at slide 17, which is the U.S. Treasury curve, again, just like the German curve, you see big shift in June and July, coincident to when CPI started to come down. Another big shift in November and December, particularly with the US CPI, the October CPI back then. And then another major shift in January, which is more and more inversion on these curves, which from a very broad perspective means the market is more and more certain, sorry, Jay, that rates are likely to go lower. And we can continue to look at all of these markets. Slide 18 just looks at the curves. You see how the U.S. Treasury curve and the German curves look too much alike, which is very concerning. Slide 19, Eurodollar futures. Again, we have that shift originally around May, June, and July, then another one in November and December, and then again in January. Eurodollar futures quite literally mean market hedging in a way that will pay off when rates go lower in the future. So market after market after market, it's not just Treasury, it's not just the yield curve. We see it in Germany, we see it in Canada. I mean, any number of markets around the world that are heavily inverted, which suggests that Jay Powell has got his outlook and forecast wrong. Because we agree. If his outlook comes true, there would be no need for interest rates to go lower. If the economy was in a relatively good place, both here and abroad, no central banks would need to cut rate. Yet every market is priced so incredibly heavily as if rates are going down, which only raises the question, why? What is it that's going to force central bankers to lower rates or yields to go down on their own, regardless of what central bankers do? Usually those things go together. Usually rates start to go lower and then central bankers follow along afterward because they're always reacting to what's going on in the economy. And if you go to slide 20, the markets must be ignoring, for example, the January payroll report, because the January payroll report was absolutely huge, made it seem as if the U.S. economy is not just doing well, it's doing really well, if not too well. And I have to believe, too, Eric, that the Federal Reserve and Jay Powell probably looked at that as an outlier month, too, probably didn't put too much stock in it, which is why they made their statements at the press conference, likely knowing ahead of time that the payroll number was going to be good. And of course, you can see, high frequency data tends to be noisy anyway. Go back to last July, we had a plus 500,000 month back then, and we don't really remember that one because the labor market continued to slow there. But even so, the establishment survey sort of projects the best case scenario. Throw out the January number, and you can see that the labor gains had been slowing down to begin with. But then you look at some of the rest of the data, including the household survey for employment, which is on slide 21, adjusting for the population control factor and some of the statistical stuff that gets thrown up every year in benchmark annual revisions. What you see is that the household survey has been behaving very, very, very differently from the establishment survey. The picture of the labor market from the household survey looks like the beginning stages of a recession, whereas the establishment survey looks like everything is fine. So we have this huge discrepancy even within BLS data series, where one looks like what the markets are pricing and the other looks like what the Federal Reserve wants it to. And I think the most important part of that on slide 22 is that we look at the household survey for full-time employment. Because before we get into any actual contraction, companies will be very careful. They'll see a small drop-off in demand, drop-off in their revenue, therefore slightly less profits, and they won't respond immediately by firing all their workers. Instead, they start to manage their cost structure more carefully. In a lot of cases, what they do is they institute hiring freezes, or they start to cut back hours from some of their existing workforce. So you might see, for example, the level of full-time jobs, it won't necessarily immediately contract, but it does tend to stop growing. And in the case of last year, right around April, which is when we had after the first initial energy spike, which probably caused a lot of businesses in the US and global economy to look at their costs and say, with these higher energy prices, can we afford to hire new workers? Do we have to start cutting back on our activities? And according to the household survey, the answer was decidedly yes. And if you go to slide 23 also, what you see is that this is generally what happens before each and every recession. The level of full-time jobs which was expanding beforehand, doesn't immediately shift into contraction. It goes through this multi-month rollover process where businesses stop hiring. Businesses cut back on their hours before they start really letting go lots of workers. And it has followed the recession path almost to a T over the last year, which again is consistent with what we see in the marketplace. Whereas if it continues to follow that pattern, we should start to see over the months ahead where businesses have finally thrown in the towel and said, we need to start really cutting workers because, we were careful. We held the line on jobs and cut back some hours, but the economy's not getting better. Our revenue and profit prospects aren't really improving. The economy overall is, quote unquote, too uncertain for us to continue this way. So eventually, unless the economy actually does start to come back, businesses will start cutting workers. That's what we see consistently all the time. We transition from expansion to contraction, not all at once, but usually it's this multi-month process.
Now, let me ask a crazy off-the-wall question here, because what you're saying is the markets are discounting lower interest rates. What I'm about to say is definitely not my view. I'm just trying to be a good interviewer here and cover all the possibilities. Isn't there a case, if you really believe that the Fed has achieved this soft landing, that says, okay, well, what's going to happen is the Fed will succeed at completely containing inflation. Without inflation, there's no need to keep rates up. There's no recession coming, but we'll be able to lower rates despite the fact there's no recession because the Fed, with Jay Powell wearing his Superman t-shirt, has successfully tamed inflation and made it go away.
Yeah, and I think that's the long-run view of the Federal Reserve too. Is that when you look at the dot plots and all of the forecasts that come out of their longer run projections, what they say is the longer run neutral rate has only ticked up a little bit higher in their estimation compared to where it was before 2020. So eventually that means that rates have to come down to meet their long run average. But that's not what markets are pricing here. Markets are pricing rates coming down far sooner than the Jay Powell and the FOMC is projecting. The dot plots, as he said in his press conference, I don't see us cutting rates this year. Well, Eurodollar futures and other markets do this year in the near term. We even see this inversion in the Treasury curve where the 6-month yield is above the 12-month yield. So there's a greater probability priced into the markets right now that rate cuts happen before the Federal Reserve is willing to do them. That can't be the natural progression of yields and rates to their longer run average. That means something interrupts that process because remember what Jay Powell has said, the FOMC has been absolutely clear about this. They want to hold rates where they are, wherever they get to the terminal rate. They want to hold them there as long as they possibly can in order to ensure that according to their model of the economy, consumer price pressures really do leave. And the markets are saying something will happen before that time that will cause you to rethink that stance. And when we're looking through all of this economic data, you can see why markets are predicting that or forecasting that. The chances of a premature, involuntary rate cut regime would be consistent with what you see in full-time jobs, for example. Because in full-time jobs, you see the economy rolling over toward what looks to be recession. With curves as heavily inverted as they are, again, we haven't seen this really since 2007. And in some cases, some parts of the curves, we haven't seen this since the 70s. They're really saying that the range of potential scenarios moving forward, they really start to look ugly. And again, I think a lot of the data suggests is what markets do, but you still have this gray area ambiguity and confusion because not all the data is in agreement, like the payroll report and some other accounts too, which suggests, well, maybe the economy is doing fine. And it's really not until all the data moves in one direction or another that we all can say for sure that what has happened has happened. Remember, back in 2008, the NBER, for example, the economist group who have taken it upon themselves to officially declare recession and recovery, they didn't declare the Great Recession and recession until December of 2008. That was months after Lehman Brothers and all that. And what they said was, well, we looked at the employment data. And the employment data was fine until around September. I mean, it wasn't good. It looked like the economy was slowing down. It was experiencing some trouble, but it wasn't until the summer of 2008 that we could really see clearly that we were in a recession. And the Federal Reserve, everybody else was in the same of the same agreement. If you look at the transcripts in 2008, the June transcripts in particular, the forecasts were that the U.S. economy would avoid recession. In the middle of 2008, they were still optimistic that the economy would avoid recession that markets had already predicted, priced, and anticipated the year prior.
Okay, and what we're seeing in this case is the Fed is basically anticipating a victory where we have a slow and gradual return to lower rates because they have succeeded at taming inflation. But you're saying, but the market is predicting you panic like later this year, and it's not about declaring success and victory. It's about a recession that forces a panic rate-cutting cycle to begin before this year is out.
Yeah, some form of involuntary aggressive action, because that's what markets are really priced for. That sort of probability.
Okay.
The level of inversion, again, I think it precludes the idea that the economy is going to gently sail into a soft landing. We're all going to be celebrating Jay Powell's skill and acumen. That doesn't seem to be in the cards, nor does it seem to be in a lot of the data points, especially some of the key forward-looking stuff, which, again, we'll get back to the slides on slide 25. I think the ISM, which is one of the ones a lot of people pay attention to for good reason. It's one of the oldest ones around. In particular, the new orders number. We know we have an inventory problem globally, which is a bigger problem than it usually is historically because of all the supply chain issues over the last couple of years. Now we see that the index, the headline index, as well as the new order index, is really in not just recession territory, but also solidly recession, nasty recession territory, which is going to spill over not just in the U.S. manufacturing economy, but also the services economy, as well as producers overseas, because of how much Americans in particular fell in love with shopping on Amazon.com, which a lot of those goods that were bought on Amazon were shipped here from overseas. So this is going to spill over globally too. And you look at slide 26, a lot of data on the services economy in the U.S. suggests that we're already in a severe recession. And Eric, where have all of the layoff announcements come from? That's another thing. We keep seeing, yes, the establishment survey and the payroll report looks fine, but we keep hearing about all of these layoffs from some of the biggest name companies. Yes, anecdotes are not data, and the plural of anecdotes is not data, but there is a solid number of indications that show the services economy is experiencing an unusual level of weakness too, which we see in some of the surveys. The ISM's non-manufacturing survey seems to be an outlier, but even there, it's a relatively low number. Look at some of the Fed regional surveys for services. And what I'm saying is that there's a broad consensus, maybe outside of a few data points, which look more like what would lead the economy into a situation, what markets are predicting and pricing. There is a consistent message here in the US as well as Europe. Markets which are leading in the economy and the data are eventually following along.
I love the pictures on page 27. What did just happen to Hu Jintao?
Well, I think it was I don't know if we'll ever know for sure, but it seems to me it was a very much scripted, planned, as much as it was supposed to be this random health problem, as the government said. I think it was Xi Jinping really cementing his legacy, symbolically having maybe the last president who was symbolic of the Chinese communist version, which embraced global liberalization, having him forcefully removed or escorted out of the party Congress, which is all about show to begin with, was him saying, this is a new China, politically, economically, socially, in a lot of different ways. And it's not just a new China in 2022. This has been coming for a long time. The trend toward this type of one-man rule started way back earlier. It was really cemented with the 19th Party Congress in 2017, which, if you recall, the Chinese said, we're doing economy differently here. We're doing quality growth rather than quantity growth, which has led to 2021's introduction of Xi's Common Prosperity Mandate, which, getting back to our original discussion here about soft landing fever, this is the political backdrop for China's actual economic priorities. unlike the maybe under Hu Jintao's regime, you're not going to see the Chinese respond to economic weakness with textbook Keynesianism. In fact, we haven't. The Chinese economy has been especially weak over the last couple of years, regardless of pandemic and policies there, underlying economic structural weakness that we haven't seen the types of responses that we did in the past. So if the idea is that China removes its zero COVID policies, which will unlock and unleash its potential, I think many people are going to be disappointed that that potential might be a lot less than maybe hoped for. If you go to slide 28, we don't have a whole lot of data just yet about full reopened China. We just have the January PMIs from the NBS. And what they look like is really disappointing because they look a lot like when Shanghai reopened last year, which obviously that didn't amount to much anyway. And what I think is more important and more potentially more of a factor moving forward is that in the middle of last year, when Shanghai and the East Coast was reopened, the global economy wasn't as bad a shape as it is today. So it may be that the global recession that's developing here and abroad in Europe and other places actually has more of an impact on China than China reopening might have on everywhere else. You see that in the PMI data, for example, the new export order components for both the non-manufacturing and on slide 29, you see it on the manufacturing PMI. And even the manufacturing PMI headline isn't all that great either. So it may be that China reopening turns out to be more of a disappointment like it was last year and doesn't contribute to the sort of economic activity that would help the rest of the global economy avoid a recession. And if you go to slide 30, just kind of finishing up here, Chinese exports to its biggest customers, the US and Europe, those fell dramatically. Again, we see this in November and December, just as curves were shifting to more greater inversions, which again suggests that demand for Chinese-made goods has fallen off sharply, which will hinder Chinese reopening. However good that might have been otherwise, like I said, the global economy may hinder China more than the other way around. And then just one final market curve, which has kind of got me fascinated in focus, which is the oil curve, WTI in the US, which no matter what happens up and down over the last couple months, as you can see on both slide 31 and 32, it can't shake this contango, which really, I mean, given, as Eric, as you pointed out, the tight level of supplies and ridiculously low levels of inventory, yet we have these curves incentivizing more oil going into storage, which to me suggests either fears over liquidity or fears over demand more than anything, which, just wrapping up the entire presentation here, all of these markets, as well as a good chunk of the data, suggest that maybe we haven't avoided the worst case. Maybe we aren't heading toward a soft landing. And if it looks like we're heading toward a soft landing, that's just because recessions look like soft landings until they don't.
I want to come back to China for a minute because my view until recently had been, okay, we're not sure exactly of the timing, but at some point China reopens completely. They are a huge economic engine. They consume more oil than any other country on the planet, including the United States. It's got to be a big deal when China reopens, and it's just a matter of time. Well, when I first started developing those views, that was before we had U.S. generals announcing to their staff in very public ways that they expect to go to full-on war, hot warfare between United States and China by 2025. There's a big difference between China, the engine of economic growth, reopening and going on to resume its usual role of supplying the entire world with cheap stuff, to China reopening to face a war with the United States. So what's going on here? Personally, I don't really understand the rationale for why there's so much intensity, at least in the current political administration in the United States, toward aggression toward China. But it seems like there is. Is that what's driving this change in economic expectations for China's reopening? And what do you see on the horizon with respect to growing geopolitical tension between U.S. and China?
Well, taking the first question first, I think, again, people have been overestimating China's potential contribution to the global economy. Again, going back to the 19th Party Congress, the way China looks at its economy is very different now than it had been. And so I think that what the oil market in particular is telling us, because you're right, Eric, China reopening should be a huge contribution to global demand for energy. Yet we don't see it in the curves here. The curves are still looking at as if we need more oil going into storage, when if China's reopening if it's going to be a robust reopening, that should sap supplies and production and inventory even more than it already has. Yet the markets don't seem to be concerned about that at all, which indicates that the markets are more concerned about at least near-term and intermediate-term demand and money considerations, which, again, I think is consistent with the overall story what we see in all of these curves, that it can't be a soft landing. It has to be more concerning than that. It has to be more of a contraction that's probably not going to be, even if it's sharp, it's probably not going to be short either. Otherwise, again, I agree with you. We would see that in the oil futures curve because China is the biggest importer, the biggest consumer. And for much of last year, for good chunks of last year, they had, for non-economic reasons, closed down a huge part of the country. But as far as the long run geopolitics of it, I think that's just part of the deglobalization trend. I'm certainly not going to speak for American government and officials and military or otherwise, because it would be crazy to do that. But it's just, historically speaking, we have these periods of globalization and then deglobalization, which are closely tied to monetary conditions. This is what happens. When you have deglobalization, countries no longer really feel like they need to cooperate, overlook minor issues like balloons like they might have in other periods, and instead hype up every little friction as if it's the biggest thing. Because deglobalization is really about fragmentation, where countries and political regimes start to look closer to home and only care more about taking care of their own rather than getting along with everybody else. And I think that's as true as here in the US or in Europe as it is in other parts around the world. It's simply the overriding deglobalization trend, which is reaching uncomfortable levels, to say the least.
Jeff, I want to ask you a question about that WTI futures curve on slide 31 and how you're interpreting that slight contango at the front of the curve. Because on one hand, you could make the argument, at least as of today on Tuesday afternoon, as we're recording this, the third month, that is May-June spread, has moved back out of contango into a very slight backwardation. The first 3 months were in contango. Now it's just the first 2 months. But the point is, okay, a reasonable person could argue, look, guys, you're only looking at the first 2 months in a fairly modest contango. It's not that big of a deal. What are you making such a big deal out of contango at the front of the WTI curve? We have, contango at the front of the WTI curve. Historically, it's been there a lot of the time. And I don't interpret it that way at all. I see this contango right now as a really big deal. And the reason I say that is because of absolute inventory levels right now. In other words, as you said, what puts you into a contango situation at the front of the curve is the market is incentivizing storage of oil. Well, storage of oil has to have a cost, which is based on supply and demand. So when the tanks in Cushing, Oklahoma are at 90% full and you've barely got any space left, you got to have really big contango in order to incentivize storing any more oil. What we have now is generational lows in inventory levels. All the tanks all around the entire country are mostly empty. They've got lots and lots of space in them, so storage shouldn't cost much of anything. And we still have the first 3 months in contango in that situation. To me, it's equivalent to a much steeper contango if we had normal inventory levels. Now, I'm inventing this rationale in my head. That's what makes sense to me, but I can't look that up in a book and say, here's where that's how it's supposed to work. What do you think? Is that the right way to interpret this?
Oh, you're not inventing this at all. I think that's the only way to interpret this, right? Because there should not be any contango whatsoever. The level
at these inventory levels, for there to be any contango is crazy.
It's absolutely insane. The curve should be steeply in backwardation. So the fact that it's even a couple pennies in contango at the front of the curve already grabs your attention, because it shouldn't happen at all. This should be nowhere near the WTI curve. And the fact that it is not only that it's there, but that it has persisted. And again, I didn't put it on the chart, and I probably should have. If you go back to slide 32, you see that steep drop off in the shape of the curve. Guess what that is? That's the October CPI. It's all consistent with what we're seeing across all of these markets. The markets are interpreting the slowdown in consumer prices as demand problems ahead. And yet, I agree with you, Eric, 100%. There should be absolutely zero contango on the curve. And the fact that it's just a couple pennies or less than $1 at some of these spreads. And yeah, it does. The contango moves from the May to June contract in and out depending on any given day. And I think what will really bother me, or what will really grab my attention moving forward, what will be a warning flag, is if the contango does start to spread beyond the near term or deepen up at the front end of the curve. But yeah, the fact that it's negative at all, that there's any contango at all, is a huge, huge warning flag, especially with China reopening. China reopening is supposed to boost demand. I mean, we're at record low inventories. Those should be gone to begin with, because China's reopening and the global system needs to adjust for more oil heading to China. And for some reason, the WTI curve doesn't seem to care one bit.
Well, Jeff, I couldn't agree more on the interpretation of the WTI curve. That does leave us out of time. I can't thank you enough for a terrific interview. Before I let you go, though, I want to go a little deeper on what's going on at Eurodollar University, because you, in our previous interviews, were working with another asset management firm. You have decided to essentially focus entirely on Eurodollar University, your study of the global Eurodollar market, which has been fabulously popular with our listeners. For anyone who's not familiar, you can go to macrovoices.com/edu for the original Eurodollar University, which I think was really just the first incarnation of something that kicked off a much bigger activity in your life, Jeff, and for the education of our listeners. So let's start with the end of the first incarnation. Give us the rundown. What's happened? How have you basically grown this Eurodollar University idea? And particularly, I know for people who are fascinated with this, you now offer much more in the terms of subscription services and so forth. What is available at eurodollar.university?
Yeah, you're right, Eric. This actually did grow out of our original premise, which you told me way back when that we needed to work on this, because it wasn't in the as good of a deep, a really fundamental format that it needed to be. And that was always kind of in the back of my mind, to really focus on this Eurodollar monetary story, because it seems to be missing and nobody really else wants to do it. So it's missing from mainstream discourse. And I've been fortunate over the last year or so to be able to launch Eurodollar University. As you pointed out, we have subscription services and membership videos where you can subscribe, you get various things. I do a daily briefing where I talk about the macroeconomic developments and market developments through the lens of the Eurodollar system, curves and whatnot. I do a deep dive analysis every day where we go into a particular topic and really take it apart. We also have Eurodollar University memberships, which have exclusive videos and content. It really goes over what is money, what is Eurodollars, what are all these curves mean, whether really the basic fundamentals of money and finance, at least from the macro perspective. And of course, I also do a regular YouTube show, which is called Eurodollar University. You can find that on YouTube. But everything, all the information, as you pointed out, is at our website, eurodollar.university. It's really my way of picking up where you and I left off and really trying to make this more of an intuitive as well as instructional type of service.
And just for the benefit of any newcomers who don't know what we're talking about, the Eurodollar system is the global lending system which allows U.S. dollars to be created or loaned into existence by international banks. And the premise, tell me if I'm getting this wrong, Jeff, the premise of Jeff's basic hypothesis is most people think the Federal Reserve is in charge of how many U.S. dollars are in circulation in the world. That's not really true. It's actually the global banking system that loans more or less U.S. dollars into circulation than the Federal Reserve actually controls. And it's an absolutely fascinating alternate look at how the global monetary system really works and what drives it. Do I have the gist of it right?
That's the basic stuff of it. And it's It really does. It blows your mind when you start looking into all of the details, the plumbing issues, how these things work together. And I think once you start doing that, it explains the world and the historical developments so much better than what we've been told.
Patrick Ceresna, Nick Galarnik, and I will be back as MacroVoices continues right here at MacroVoices.com.
Now, back to your hosts, Eric Townsend and Patrick Ceresna.
Well, Eric, it was great to have Jeff back on the show. Now, joining us again in the post-game is Nick Galarnik. Let's get to that chart deck. Listeners, you'll find the download link for a post-game chart deck in your Research Roundup email. If you don't have a Research Roundup email, it means that you have not yet registered for MacroVoices.com. Just go to our homepage, MacroVoices.com, and click on the red button over Jeff's picture that says Looking for the Downloads. Let's get to talking some of these charts. On page 2, we have the S&P 500. What levels are you watching?
Yeah, so looking ahead to next Friday's OPEX, the February monthly OPEX, the expected move is about 100 points in other directions. So current spot is around 4160. Upside would be 4260. Downside around 4060 or so. And keep in mind, looking at the support areas on the chart, they're pretty heavy at 4,000, then below at around 3,800, and then obviously back at those October lows at like 3,600 or so. On the upside here, if we keep pushing to the upside, it's possible we touch 4,300 or so, which would be heavy resistance back from late August, late September of last year. But Eric, what are your thoughts here?
Well, a few weeks ago, we broke above the 200-day moving average, where a lot of our expert guests have told us is where bear market rallies often end. Since then, there's been a nice clean rally up to the 50% Fibonacci retracement at 4153. That's the 50% of the overall bear market. And we're now consolidating along that resistance. I won't be surprised to see a rally up to the 61.8% Fib retrace. That's 4308. If this really is a bear market rally, it ought to end by that point. And if the Fed really is done tightening and Jeff's prediction that they'll be forced to ease proves false, then I suppose maybe the bottom really is in for this market. But frankly, I think Jeff's scenario is more likely. So 4309 is probably your selling point to short this market if you haven't shorted it before that. And of course, if you think the Fed really has pulled off the soft landing and there's not going to be any more recession than there's already been, then I suppose the bottom is in. But that's not the way I'm expecting it to play out.
I find it interesting that all three of us have very similar levels in mind. Obviously, all eyes are on that August high near 4,300. Yeah, it lines up with the fib zone like you're talking about there, Eric, and certainly there's a substantial option open interest there as well. But I like to just really keep it simple here. And obviously, on one side, we have all the signs that maybe the raising of these rates will inevitably trigger some sort of an economic recession. But until the market wants to care about that, the prevailing trend is very distinctly, at least in the last month or more, the market wanting to go higher. And we continuously see accumulation, higher highs, higher lows. Each dip is being bought. And so you have to assume the path of least resistance is that prevailing trend to that very number that you guys are talking about. And but what will be really interesting to see for me is when we see the behavior of these markets start to shift, but there clearly is no sign of that. So I agree with both of you in terms of that upper level as being the point to watch here going into next week. So I want to talk about the NASDAQ here, Nick, and on those QQQs. What's interesting is from a percentage return perspective, the NASDAQ has had a really good run, but I think that's reflexive of the fact it's been just such a heavily beaten down market in the prior 2022 year, and then reflexively it's just simply just getting from such an oversold level to the upside. What's your take though on the levels here on the Qs?
Yeah, I mean, tech has performed very, very well this year thus far. We're up from the bottom back on January 6th or so, the recent bottom anyway. We're up about almost 20%, which is not inconsequential whatsoever in about a month's time, which is pretty crazy. But looking at, again, next Friday's expiration, February 17th, the expected move is about 10 points here. Spot is about 308. And the upside would be 318. Downside would be around 298, which also has support right around 297 or so. Mental support is around 300. And again, we gap filled that area of 310, 311 from a few months ago. So the next upside move would be somewhere around 320, then 330. There is a gap also from late August, early September, right around like 320 area or so. Again, we're seeing a lot of strength regardless of poor earning reports. And that tells me that there's probably more upside ahead. So, don't fight the trend, right? And you want to look at what's possibly going to happen this year. We had a terrible year last year in tech. It's possible this year is the year of recovery.
Yeah, well, I'm not sure I agree with that, but we'll see how it plays out. But anyway, let's move on, though, to the volatility index. And what was interesting is when we were recording last week, we had that breakdown below 18. It just looked like the feet was kicked out underneath volatility and it was going to head down. And it hasn't really recovered, but I would say it's more like it's come back into the trade range and that breakdown never followed through. But low volatility conditions continues to be the case. Does that change your levels in any way on the VIX?
Not too much overall. Looking at the current VIX spot is around 19.2 or so. Daily expected moves is about 1.2% in broad markets. Again, like support's pretty heavy at that 18 mark. We tapped 20 and then came back down again yesterday. And unless we get above 25, I'm not too concerned going forward. If you're a bull, short term, you might get a further rally, but being bearish in these type of dull markets where we get a bit of chop, gap ups and then more chop, it's kind of dangerous because again, you can be correct in your thesis overall that we may see lower lows in the future, which is what I think, but we also may not see that for a while. So if you time it incorrectly, you can still lose and be correct in your thesis overall, in long term, but not get paid for that, right? So that's a danger in shorting the market in the short term. You need to have a longer term approach. And again, being along in the market overall is a much, much better way to make your capital work for you. So the VIX right here, unless we see a spike above 25, I'm not too concerned right now. We could putter in this area for a little bit, but looking at the past year or so, we have historically bounced off pretty heavily, but that would probably require some kind of volatility inducing event. Earnings may have, I thought earnings may have been that event, but thus far that hasn't been the case at all. So moving on to page 5 with the US dollar, Eric, what are you thinking over here?
Well, the Dixie paused at 104 as support on the way down, and of course that support failed, and we moved almost down to 100. Now it's pausing just under 104 as resistance on the way back up. So the big question is whether it breaks above or rejects at 104 on the way back up. I don't have a strong view on which is more likely to happen, but what happens at 104 and whether it breaks higher or reverses and moves lower is going to be the tell that indicates where the next leg is going to go from here.
Yeah, Eric, you're bang on with that short-term high at 104. That is now a very important pivot because, look, the dollar was incredibly oversold. I mean, we basically had on many cross currencies, 2,000 plus pip moves on so many of them, and just such an incredibly short-term oversold dollar. And it was inevitably going to bounce, and we got a pretty violent bounce on in the post FOMC and jobs numbers reaction. But this is the moment of truth, because if we see that the dollar fades all the way back down to its lows, then nothing has changed. It means that the dollar was just oversold. It had a reaction. It faded back to its lows, and the prevailing trend is dominant. But at the same time, if we're recording this MacroVoices next week and the Dixie has broken north of 104 by then we have to really start entertaining the idea that the dollar that's been in more or less a 4+ month consolidation may be attempting another breakout attempt. I don't feel that I need to make that call with high conviction today. It's one of those things that we now can watch that 104 level on the Dixie and really just see whether the bulls can crack that level and squeeze the shorts here. And that's certainly something to watch.
Now, moving on to page 6, we have this chart over here of gold, which last week broke down surprisingly, or to my surprise rather, from the high 1900s level down to 1875 or so. What are your thoughts over here, Eric?
Well, I complained a couple of weeks ago that the only thing not to love about gold was that it hadn't given us any meaningful corrections to allow new longs to get into the market. Well, I guess I got what I hoped for. Last Friday, we had a slam down that looks to me like the beginning of that substantial correction. Now, I doubt it's over after 2 big down days. I'm guessing that what we're seeing in the last 3 sessions is just a dead cat bounce, and that maybe we'll get to new lows. I'm targeting the 38.2 fib retracement, which is at 1838, to add to my longs. It's entirely possible we could see lower numbers if this turns into a substantial correction. 50% fib retracement is at 1795. The 61.8 is at 1753. Healthy bull markets need corrections to shake out the weak hands, and gold is a famously volatile market, so more downside is entirely possible, but I see no reason to conclude that this bull market has ended. This is just the first meaningful correction in a new uptrend as far as I can see, and what the dollar does at 104 is probably going to indicate where the next leg in gold comes.
Yeah, Eric, I obviously am a big fan of Fibonacci. So when you're talking these levels, you are certainly talking levels that are on my charts as well. The one thing, though, is that to me, gold at this juncture has still demonstrated just simply its behavior of acting as a cross currency to the dollar. It's no coincidence that reversal off the top in gold lined up with the squeeze higher in the dollar. And just like I was talking about what's next for the dollar off of that 104 level, I think that in the same way, it's going to determine at this moment whether or not gold has still deeper to go in this correction or not. I mean, if the dollar fades all the way back down to its lows and looks like it's staying in trend, gold may already be putting a short-term bottom. If we do have that deeper correction, if the dollar does squeeze a little higher, you're bang on. I'd love nothing more than to be able to reposition a new long on gold in the 1800 pocket. It's certainly the level to watch there. Moving on page 7, I wanted to talk crude oil, and I know you were talking about it earlier, Eric, and all I wanted to observe is that even though the last 2 days have seen a bounce off of that support line, the one thing I'm waiting for is when crude oil's price action is actually going to show some sort of sign of accumulation. I mean, there are all the cases to be made that at some point there's going to be another bull leg in crude. And the biggest puzzle piece for us to solve is when has that new trend begun? And at this stage, while we have bounced off that level, until we're in the low to mid 80s and really neutralizing this sell cycle that has demonstrated lower highs, lower lows, and just a prevailing downtrending pattern, until we see that, you have to respect the prevailing downtrend as dominant. If, for whatever reason, crude oil once again fails here to make a higher high and fails here at the 78 level, it becomes vulnerable for temporarily dipping to new lows just to psychologically wash out all those people that are so determined that the bottom is in. One way or another, I get the bull thesis. I'm looking forward to when the technicals line up to support that bigger view. The last thing I wanted to just touch on is those 10-year treasury yields. And what's interesting is when you were interviewing Eric, Jeff there, talking about yields, talking about oil, all of these things were touched on. Obviously, with inflation coming back, you would think that naturally that would be a condition that would stop putting pressure on bonds and allow yields to some degree or another mean revert, maybe even as low as 2.5%. But what we see here is in the post-FOMC and jobs numbers, we had a jump in yields. But this jump in yields echoes a lot like the jump in the dollar or jump in all of these different moves. What I'm very curious about is whether or not there's going to be a prevailing bond weakness that pushes, let's say, bonds back to their lows or yields back to 4%. Because if all we see is us fade off of this little pop from 2-3 days on the upside of the yield, which obviously is testing that 3 365, 370 zone on the upper boundary of it. If it fades right back to 340, maybe there's more upside on bonds, and as yields just continue to back off in this condition. It's certainly such an interesting moment in the macro space as to whether these things that have been in place for the last 3-4 months, whether these trends really in fact are going to shift.
Folks, if you enjoy Patrick's chart decks, you can get them every single day of the week with a free trial of Big Picture Trading. The details are on the last pages of the slide deck, or just go to bigpicturetrading.com. This episode of MacroVoices was made possible by Respect Energy, a leading European trader of renewable energy and a one-stop shop for all green energy investors. Patrick, tell them what they can expect to find in this week's Research Roundup.
All right, in this week's Research Roundup, you're going to find the transcript for today's interview with Jeff, as well as a link to his slide deck and the chart book we just discussed here in the post game. There's also a link to a number of articles that we found interesting, so you're going to find this and so much more in this week's Research Roundup.
Well, that does it for this week's episode. We appreciate all the feedback and support we get from our listeners and are always looking for suggestions on how we can make this program even better. For those of our listeners that write or blog about the markets and would like to share that content with our listeners, send us an email at researchroundup@macrovoices.com, and we will consider it for our weekly distributions. If you have not already, follow our main Twitter account @MacroVoices for all the most recent updates and releases. You can also follow Eric on Twitter @EricSTownsend. That is Eric spelled with a K, and follow Patrick @PatrickSeresna. On behalf of Eric Townsend, Patrick Seresna, and myself, thanks for listening, and see you all next week.
That concludes this edition of Macro Voices. Be sure to tune in each week to hear feature interviews with the brightest minds in finance and macroeconomics. Macro Voices is made possible by sponsorship from BigPictureTrading.com, the Internet's premier source of online education for traders. Please visit BigPictureTrading.com for more information. Please register your free account at MacroVoices.com. Once registered, you'll receive our free weekly Research Roundup email containing links to supporting documents from our featured guests and the very best free financial content our volunteer research team could find on the internet each week. You'll also gain access to our free listener discussion forums and research library. And the more registered users we have, the more we'll be able to recruit high-profile feature interview guests for future programs. So please register your free account today at macrovoices.com if you haven't already. You can subscribe to Macro Voices on iTunes to have Macro Voices automatically delivered to your mobile device each week free of charge. You can email questions for the program to mailbag@macrovoices.com, and we'll answer your questions on the air from time to time in our mailbag segment. Macro Voices is presented for informational and entertainment purposes only. The information presented on Macro Voices should not be construed as investment advice. Always consult a licensed investment professional before making investment decisions. The views and opinions expressed on Macro Voices are those of the participants and do not necessarily reflect those of the show's hosts or sponsors. Macro Voices, its producers, sponsors, and hosts Eric Townsend and Patrick Seresna shall not be liable for losses resulting from investment decisions based on information or viewpoints presented on Macro Voices. Macro Voices is made possible by sponsorship from BigPictureTrading.com and by funding from Fourth Turning Capital Management, LLC. For more information, visit MacroVoices.com.